out for you. So that's what I hope to do today, is kind of formally lay out the behavioral biases and go over examples maybe from investing or from your own life where each of those behavioral biases you've probably either experienced or you've seen other people experience. So and that should get wrapped up today. Next time then, I'm going to start Unit 3. And I've already posted the assignment for Unit 3. Unit 3 is fairly involved, and it may end up taking me more than 1 week to do it. This is the rational finance, the traditional finance that you've been hearing is so crazy, but it's kind of the bedrock of finance. So I'm taking what would have been in a textbook in chapters 6, 7, and 9 and kind of smushing it all together. There is math involved, so that might scare some people, but there is some math involved. I'll try to make it as intuitive as possible so that you walk away with something that's reasonable. Your assignment will just give you an introduction to the concepts, but it's not heavily math. It's more the kind of the conceptual side of it. And then I want to, in class, bring the math side of it. And like I said, it may take me 2 sections. It may take me 2 classes to do that. So I will still post the assignment for Unit 4 then, and that will just stay on track because it's not terribly involved. But I may have to take the class 2 in a row that to cover all of Unit 3. And then when we get to bonds, that's also kind of mathy. So there's some numbers involved with Unit 5 rather. And then when the very last unit, I'm always over ambitious. I always plan to do a lot more in that unit than I can ever do. And I've been teaching this class for a long time. So we will do as much as we can do, and wherever we end it, that's where the exam falls. Right? The assignment for Unit 6 is another movie. That's another PBS movie. So I could actually make that available sooner rather than later because you can watch that anytime. So if you know you're on the road or something, you want to, an hour to watch another movie, we could do that. So I can post it, but we're not going to discuss it until we get to the very end. So that kind of gives you an overview of what to expect for the rest of our time together. Any questions so far? Okay. So I want to talk today about behavioral finance. And as you got a sense from that movie, there's kind of 2 worlds of finance. There's traditional finance that's grew out of econ, and then there's this kind of newfangled notion of behavioral finance, which brings psychology into financial markets. So how would you characterize traditional finance based on what you saw in the movie so far?
Markets are always rational.
Rational was a key word.
Mathematically predictable.
Rational, efficient. So these are the traditional finance.
Self-regulating.
So rational is a big word there. Efficient. What did you say? Self-regulating? So if markets were truly rational and efficient, we wouldn't really need the government to step in and put any kind of breakers or restrictions on trading. So it would be self-regulating.
And predictable with mathematical equations, at least people's behavior is predictable?
I think not that it's predictable, I think that it can be modeled. Because predictable means that if I'm standing here, I know what's going to come tomorrow. And this actually says it's not predictable, that I can't tell what's going to come tomorrow because everything that we know about a market is already built into the price. And since I don't know what new information is about to arrive tomorrow, I can't know what's going to happen to the price tomorrow either. So it's not that it's predictable, but it can be modeled mathematically. Okay, so that kind of captures what traditional finance says. Let's just define this word rational for a minute. Rational to the layman means that it makes sense, but in finance terms, there's a little bit more to it. Can anybody add to what it means to be rational or the rational investor?
It's based on like studious research, thorough.
Yeah, so all the information is captured, and that actually is more about the efficiency, that all of the information that's available is already reflected in a price.
Well,
Isn't it about acting with always acting in self-interest? That a rational
Yes,
person would always
a
act.
rational person will always make the best choice. Yes, it'll always be in their best self-interest.
I was just say maximizing utility.
That's actually the mathematical side of a rational investor. They're going to maximize utility. And sometimes they're called mean variance optimizers. Is that a word that you've heard out there somewhere? They're mean variance optimizers. And we will calculate the mean and the variance next time when we talk about traditional finance in more detail. But basically, every investment has the expected return that everybody expects. We all have homogeneous expectations. And together, we have arrived at an expected value for the stock or the bond. And do you remember your stat, like a synonym for an expected value? How do you calculate the expected value of a series in your old statistics class? Back when you were just a kid. You calculated the average. It was actually when the mean of a series is its expected value. That is actually the best guess for what's coming up next. So the rational investor chooses to buy the investment that offers them the highest mean or the highest expected return at the lowest level of risk. They're going to maximize their return and minimize their risk. They're going to optimize this trade-off between risk and return. So we call them mean variance optimizers. In other words, they're going to find the highest expected return and the lowest level of risk. And we calculate risk as the variance of a series. How much variation there is around a series. All right? And I'm using letters that I will define more clearly next time. So I'll be more clear about them next time. But for now, this is what an investor that's rational will do. So do you remember in the movie, I think, was it Schiller said something like, maximizing my interest rate? What interest rate in my head? Remember that? Mm-hmm. That's what he's talking about. He's like, what rate? I don't know what rate. We don't even know. I don't even know what rate I'm supposed to expect, let alone find the best one. So that was the argument there. So this is traditional economic theory. And if you remember from old econ classes, you drew things like indifference curves. Is that a word that kind of, remember? Like indifference curves were based on higher utility and diminishing marginal returns, where your utility increases at a decreasing rate. Every dollar you make brings you some utility, some satisfaction. Every additional dollar still brings you some utility, but it's a little less than the one before it, and so on. So for me, who does not have $1 million, if I just suddenly fell into $10,000, it would provide me with a lot of utility. But if I already had $10 million, a $10,000 windfall would not provide me with the same level of utility. It's diminishing marginal returns. This is all the traditional stuff. All of this is traditional stuff.